If you're pitching your film as an investment, you're already starting to lose credibility. Now, I know that sounds harsh, but the second that you describe your film in a way that is similar to property, private equity, ETFs, bonds, investors quietly exit left because your film is not like a typical investment, and pretending it is ends up attracting the wrong money. So, let me explain this. When investors hear the word investment, subconsciously, they start to think of things like real estate, infrastructure, businesses, private equity, dividend stocks, those types of assets. But all of those assets have a few things that films does not, right? They've got historical data sets. They are very predictable in terms of cash flow, and you're able to really capture and protect the downside. So film has none of those things because film returns don't behave like traditional asset classes. Film is asymmetrical. It's power law driven. It's defined by black swan breakouts. Only a very small number of titles, films, generate a disproportionate amount or share of industry profits, right? And most projects are lucky to break even, or they take a modest or even substantial loss. So if you think about breakout projects, things like Moonlight, Blair Witch Project, Paranormal Activity, right? Those are kind of the more famous examples. Those are statistical outliers. So success in film isn't so much about trying to predict an average outcome, a median outcome. You can't simply take a look at all these other films and see what they did and then apply that to your film. Because in film, you're actually positioning for extreme upside in a chaotic winner takes all environment. It's like buying a lottery ticket. So that's not how bonds behave. It's not how property behaves. It's not how those typical or more standard asset classes behave. So if you're calling a single film an investment to potential investors, it implies a level of predictability that film simply does not have. And it's simply not true. So a single film behaves much closer to early stage venture capital, right? So funding things like startups. It's extremely high variance. It's speculative equity. There's a real chance that it goes to zero, right? That the business doesn't survive. But there's also disproportionate upside if it does connect, right? If it connects, it creates these unicorn companies. It's the same with film, right? So in almost every financial projection model that I built for investors, our worst case scenario shows a negligible return or negative return, right? And most filmmakers who I work with actually get nervous putting that in front of investors because they think it's going to scare them away, right? If they see this, like the low projection is like the film doesn't make much money or it loses money. But those investors who get scared by that were never really suited to the type of high risk power law asset that film is. So when you try and soften that blow for them by adding all these outlier films and you make the downside look not that bad or even attractive, you don't actually attract the type of capital that you want. You end up having misaligned capital. And misaligned capital is dangerous or can be more dangerous than having no capital at all because your investors are always going to be displeased, right? Because they're going into it with the wrong frame. So the real issue here isn't that film isn't an investment, right? It's that the word investment attracts or can attract the wrong type of investor. So when you say investment, you attract yield-seeking investors, usually conservative allocators, right? Property-minded investors. But film requires someone who is a risk tolerant. They think in portfolios and they're comfortable with variance, right? They're comfortable with outcomes that are highly variable. So just by using different wording, you can kind of filter the investors who you try to go and speak to. And when you're speaking with them, it filters the people who are in the room. The problem is most filmmakers are filtering incorrectly. So instead of saying to an investor, this is a great investment, you want to say something like, this is a high variance, asymmetric bet. It's a bit wordy, right? You could simply say it's a asymmetric bet, asymmetric opportunity. It's venture style equity, right? Something like that. Early stage startup style equity, or it's a power law asset. The upside is disproportionate and the downside is real. I like using the asymmetric and power law are the words that I like using. And over the years, and particularly today, I include more and more of this wording in my pitch decks. So that language signals that you understand the nature of the asset class. It gives you credibility, and credibility ultimately is what unlocks capital. So what you want to do here, or the takeaway that you want from this video, is to stop trying to make your film sound safe. Stop trying to create these projections that make it look like a safe bet, that the low side isn't that bad. Just start framing it accurately, because when you can speak the same language of the investors instead of this language of just hopes and dreams, then pitching to investors is going to become a lot easier. So if you want more breakdowns on how film finance and distribution works, subscribe to this channel, and I'll see you on the next one.